The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone, and welcome to the April 1st edition of Digging into the BI. This is where the DC chapter and the Maryland chapter get together and look at some of the featured stocks in the latest issue of Better Investing magazine. We had a few technological problems that were slow in getting us started, but I think we're all good to go. So here are the stocks we're going to be looking at in the order in which we're doing from the upper left, going clockwise. We're going to do Allient, then we're going to do ResMed, then NXP Semiconductors, and then Comcast. So let's go to our next slide. So this is our standard disclaimer. We're doing these presentations for educational purposes. We believe, as all investors in the Better Investing community, you should be able to conduct your own review and analysis. Any stocks that we discuss here may be held by the presenters. We try to alert you to that when we're going through it. And the presenters are not endorsing or promoting the particular uses of any websites or products that we have. And keep in mind, as you see that blue underline down at the bottom, this session is being recorded for future use, and we're going to put it up on our YouTube channel, hopefully later on tonight. Next slide. So again, most of the people I see in the audience are regulars, but since this goes out on YouTube, we want to make sure that folks know who we are. We're part of a community called Better Investing. And again, you'll see the hyperlinks down there below. If you have this presentation, you'll be able to go directly to it, but we're an investment education organization. We focus on long-term fundamental investors. All of us that are presenting here are volunteers in the Mid-Atlantic region. So that's Maryland, DC, and Virginia, although we do have a couple people from Alabama and South Carolina helping us out tonight. So thank you very much. Next slide. So here's where you can find the recording for this. This is up on our YouTube page. It's at Digging Into BI, and you can be able to see all the older ones that are there. What we've done is the webinars are organized into what YouTube calls chapters. So you don't have to listen to all of them. You can just go to the one that you want to listen to and do it. But in return for this free education program, we ask that you sort of like the videos individually. You can share the videos with your friends and make sure to subscribe to the channel. That helps with the algorithm that Google, which owns YouTube, runs on. So please help us out with that. Next slide. And again, most of you are regulars, but if you're having any trouble with this, here's again a 4-minute video that sort of helps you getting started, or you can also look at the helper audio section settings. Sometimes if you're on your computer, people aren't hitting the computer audio that goes with it. And then the key thing is, if you look at that green arrow at the bottom, that's where the handouts are. So you're going to have 4 completed SSGs by our presenters tonight, and you're going to have the entire slide deck. So please take those down. You can share them with people in your clubs or friends or people you're thinking of trying to get involved in your club or your chapter. Next slide. So why are we doing this? Well, we're all part of the Better Investing community, and we want to be able to show you how to be able to use the resources that you get through a BI membership. And again, I see a lot of regular folks here, so you already are BI members, but that blue underline there, that gives you a link to a free 90-day trial for Better Investing, and you can see all this stuff. And it's designed, again, for beginners, maybe people that are a little uncertain in their judgments, to be able to look at how we do things on both the stock selection guide and periodically we talk about the PERT report. Again, we're trying to show you the best practices of a long-term fundamental investor that uses the BI tools. And it's a way to do a joint program between our 2 chapters, the Maryland chapter and the DC regional chapter. We want to promote our model clubs, and we're also promoting the Club Connect program that we'll talk about shortly. And it's an opportunity to be part of the Mid-Atlantic chapter, although you do not have to be in Maryland, DC, or Virginia to participate, nor do you have to be a Better Investing member. We're just trying to show you some of the things that we like to do. Next slide. So in just over an hour, we're going to do 4 stock presentations, so they come kind of fast and furious. We're going to show you the 2 stocks that are featured in the current edition of the BI magazine, so that's for members only. So that's going to be the stock to study and the undervalued future. And then we're going to have 2 other presentations, and the requirement is that they just have to be something that you found through your existing BI membership and not through anything else. So unless, of course, it's a personal experience, but some of the places that in the BI community that people use a lot is a First Cut, the online screening tools, the heat map, Ticker Talk. They have a weekly screen and on and on and on. We also have the BI Top 100, and one of the stocks tonight will be part of that. Next slide. So again, and you do not have to be a member of BI, but if you go to the Better Investing website, and again, at the top of every page, you can see the URL in the white lettering with the blue background. It shows you how to get to betterinvesting.org. And then at that, here you can see, and again, you don't have to be a member, you can see the news releases and you can see what are the stocks that are upcoming. So this one for April was announced on February 1st. That's NXP Semiconductors and Comcast. Next month, and we'll talk about this at the end, we're going to do Motorola Solutions and Darling Ingredients. Again, you do not have to be a member to be able to see this stuff, so share it with your friends. Next slide. And again, if you are a member, please make sure to sign up for future announcements. You can be able to see how to do that. You first go up where the red circle is up on the top under My Account. From there, you go over, this will show up over on the left-hand side where you have the green circle. It says email and product subscription information. If you click on that, it will pull up the stuff that's over on the far right in the green box. That's what comes up in the email product subscription. Make sure to highlight that you want to be part of your local chapter where that arrow is. But before you hit that Save Changes down in the bottom right, make sure to be able to sign up for the Better Investing Weekly e-newsletter. That's the yellow highlight. And we'll show you with the next slide what that does. Next slide. So here's the BI Weekly Newsletter. This is just for members, but what it does is it highlights some of the educational things that are coming on up. It comes out usually, but not always, at the close of business on Thursday. And if you signed up for it, you're not getting it, check your spam filter. But up at the top in the where the sort of I should say light orange arrow is, that's one of the upcoming events where they're talking about a portfolio-centered decision making. And then the one down below, the blue with the red around it, that's one of the upcoming screens. So again, a great place to be able to find ideas just through your BI membership. Next slide. We can also join us on Facebook. There's Facebook pages for both the DC chapter and the Maryland chapter. And again, you do not have to be a member. It's a way to stay connected with all of us. And you can, again, share that with non-members to be able to show them what we have in our community. Next slide.
Hi, this is Cheryl Patterson. This is the Money Matters book discussion. In April, the book will be The Missing Billionaires by Victor Hagani and James White. The Money Matters is an online discussion. It's usually the third Tuesday of each month, from 7:30 to 9 p.m. And it's free and open to the public, so anyone can come in. Go to the DC chapter, and you can see under our events the link for this event, and please join us. Back to you, Kevin.
Thank you. So, Cheryl, it's actually back to you.
Oh, you're right. This is a club that Kevin and I belong to. It's called Happy Destiny Investment Club. It started in 2001, and I believe we have 6 partners currently. One of our partners couldn't make it. The next meeting is on April the 19th. It's the third Friday of the month, and it's from 6:30 p.m. to 9 p.m. Again, everything is virtual. And so the education will be the investment policy statement, part 3, and the stock to study is still being discussed.
And so this is my other club. I'm in the Montgomery County, Maryland Model Investment Club. We have 5 partners. We meet on the 3rd Wednesday of the month. We also are looking at the investment policy statement. Both of my clubs said, look, we need to sort of set that out. And it's a great time to be able to talk about what needs to go in an investment policy statement, and there's a lot of resources. And just like with Happy Destiny, we're not quite certain what we're going to be looking at for our stock study, but come on in and take a look. You do not have to be in our area to be able to participate, and you can reach us at that point of contact down below. Next slide.
Okay, back to me again.
This is Bhaskar.
Oh, this is Bhaskar. Go ahead, Bhaskar.
Hi, good evening all. This is Model Investment Club of Northern Virginia. We meet on the 2nd Tuesdays of every month, and this month it's the next week, April the 9th. We currently have about 13 partners. We started in 2008, and we discuss every month. We have an education segment and a stock study, new stock that we present. Anybody, our visitors are welcome, and you can join online. It happens only online on the GoToMeeting.
And this one we're going to hold off on. Denise Kimberlin, who's our 4th presenter, she's going to be here a little bit late, and she can be able to tell you about her model club down in South Carolina. She's a former president in the DC regional chapter, and she's joining us for the first time. So let's go to our next slide. Cheryl.
Hi, this is a new program on BI. What it's doing is it replaces that Visit a Club program, and it's actually an easier way for clubs to find like-minded members interested in joining an investment club, as well as helping individual members to connect with local clubs that are looking for members. That meet virtually. Connect can match factors such as gender, distance, and other preferences in a confidential listing. Back to you.
So again, part of digging into the BI is to be able to dig into the magazine and find some of the resources that are there. And again, you can wait until the magazine hits your mailbox, but you can also get it electronically either on the website through the e-magazine on the right, or if you signed up for the app and you have it on your phone, your tablet, your laptop or smartphone or any other electronic device over on the left-hand side, you can see it as well. Let's go to the next slide. So this is the Learning Center. And again, if you look where the green arrows on the left-hand side, that's the place where you can get the Better Investing magazine for mobile devices, like I showed you with the app. It's a different sign-in than what you'd have for the Better Investing, but if you click on it, it's pretty straightforward. The other thing is right below it where the red arrow is. That's the analyst reports and other information for the 2 featured stocks every month that we have, the stock to study and the undervalued feature. There is additional resources that the magazine will tell you about, and this is where you can find it online. So go ahead and take a look at this. And the way you find this is again through where you see the green highlight in the center where it says View Magazine Issues. Next slide. So again, one thing we like to do is feature one of the stories in the current edition of BI Magazine. In this one, every April, what happens is BI Magazine will sit there and check to see what are the most popular companies that are being held by our members in clubs. So they're using the information from my iClub accounting. That's what they determine is the most popular. It's been around since I think 84 is what I remember. I could be off on by a couple years or so, but it's a great place to be able to sit there if you're trying to get stock ideas. Look at, I heard when I first joined about 25 years ago, someone was saying, this is a great place to be able to do as a shopping list. So you can find the ones that are new to the list from 2023, and that's one that we're going to be doing today in ResMed. The other thing is you can see ones that moved up a lot. Those are kind of interesting. And then finally, there's a third group, which are new to the top 200. So these are great shopping lists. So go ahead and get in there. And when you're saying, I'm having trouble finding stocks to study, take a look at this. There's some really good ideas in there. Next slide. And then finally, this is page 51. It's always where the investor events are. I wanted to show more of them. South Florida has been doing a series on the credit market series that's free and online. And so that's going to be next Monday. Some of the others, they were really some interesting ones, but it looks like a lot of chapters are starting to do things in person. And then some others, they had already passed us. They were already in like late March. So that's the only one I really saw. I may have missed a few along the way. But go ahead and that's a great place to check. And if you are coming in from outside our area, as I do see several people there, a great way to be able to connect with other people in our community across the country. Next slide. And now, after all of this, we're going to start talking about some of the stocks. And Cheryl's going to go first. We're going to do the first two stocks in core, and she's going to talk about Allient. So take it away, Cheryl.
All right, next slide, please. So this is Allient Corporation. It's a NASDAQ company, ticker's ALNT, founded on the BI ticker heat map, all the way at the bottom of the technology column. They design, manufacture, and sell precision and specialty motion control components and systems. Next slide, please. And here is the ticker map. So you can see where in the circle in black is Allient, the ticker ALNT. Next slide, please. So Allient mainly operates and sells across the United States, Canada, South America, Europe, and Asia. Sales to US customers in the third quarter of 2023 were 61% of total sales, compared with 59% in quarter three of 2022, with the balance of sales in Europe, Canada, and Asia Pacific. Next slide, please. Its products and solutions include nano precision positioning systems, servo control systems, motion controllers, digital servo amplifiers, and drives, brushless servo, torque, and coreless motors, brush motors, integrated motor drives, gear motors, magnetic filters for power quality and harmonic issues. This company grows mainly through mergers and acquisitions, and you can see they completed 17 of those acquisitions just over the last 20 years. Next slide, please. So here is some of their system solutions they've done, again, through competitive advantage. They're looking here at system capabilities that have evolved through those strategic acquisitions. They have building blocks that include some of the things that I just mentioned. And they also have system capabilities. And it can range from vehicle steering systems with integrated drive, electro, nano, precision motion systems, ground-based vehicle electrical, and light weighting. Next slide, please. So there are 5 target markets that I'm going to show on the next couple of slides. First one here is industrial. And as you can see, the markets for this are factory automation, material handling, robotics, industrial tools, and semiconductor equipment, and oil and gas. Next slide, please. The next target market is vehicle, and this has 23% of the total trailing 12 months, say 2023 sales for quarter three. And the markets here are on and off-road construction, agricultural equipment, trucks, buses, RVs, lift trucks, marine, recreational ATVs, and utility vehicles. Next slide. Now, the next target market is medical, and that's 15% of the trailing 12 months for that same quarter three 2023 sales. Markets include medical devices and equipment, surgical robotics, patient handling, and medical mobility. Next market slide. It's aerospace and defense. This is 14% of the trailing 12 months of that quarter. Its markets are commercial aviation, aerospace systems, defense systems, unmanned aerial vehicles, and selling to NASA. Next slide. And finally, we have mega technology trends. And this is what I really like about this company. They have so many places that they sell equipment and parts to, but they're also keeping up with the technology and also the trends that are trending right now in investments. And that talks to electrification for internal combustion engines and hydraulic systems, energy efficiency in an effort to reduce energy consumption, and industrial automation, which addresses challenging labor environments. Next slide. So here we see the record revenue for dollars and millions, and you can see what's happening from 2019 all the way up to, again, that third quarter in 2023. They continue to grow their sales. Again, they have strong execution that's driving both their organic and inorganic growth. And next slide, please. Also, there's a diversified revenue mix. And again, we do it by those 5 markets that I talked about, as well as the distribution in the different markets. And also they have trailing 12-month revenue change and market drivers, up 48% for defense, 3% for more normalized sales environments, commercial, automotive, and power sports demands, offset by agricultural demand, and a strong end market demand within industrial automation, oil and gas, HVAC, and materials and vehicle handling. Next slide. Also, they are very much into cash generation. They are driving towards 95% free cash flow conversion. And you can see where each of the years they've kind of gone downhill in terms of that cash flow, but they've more than made up for it by that third quarter in 2023. They continue to drive that free cash flow with revenue expansion, improving supply chain, improving the inventory turns, working capital improvement, and they expect maintenance and growth of CapEx of approximately 3% of their sales. Next slide, please.
5 minutes, Cheryl, 5 minutes.
Thank you. Also, another thing that is in their favor is 1.5 million in foreign currency translation. They have a backlog up 3% sequentially, which reflects a large defense order and is partially offset by continued improvements within the supply chain, and then the majority to ship in 3 to 9 months. Next slide, please. And they've developed their strategy. They've aligned their entire company to achieve strategic goals and objectives. They have the technology know-how. They pursue niche target markets. They innovate leading edge products and solutions to meet the emerging needs of their served target markets. They've developed a culture of lean ALNT to create value in everything they do, to continuously improve their company performance, and they train and develop their talent and help foster a one-team approach to business. Next slide, please. So their future goals, they have today, the trailing 12 months, they've reached their revenue, net income, and EBITDA goals. And then in the future, they expect to deliver revenues of over $1 billion, 100 BPS annual margin improvement, operating margin in the mid-teens, adjacent EBITDA margin high teens, and continue organic growth at rates faster than the industry, and also continue with their acquisitions that complement their growth trajectory. Next slide. So we're going to start with the SSG, and here is actually off of the front of the SSG Plus. The rest of it is in core, but you can see the somewhat up straight and parallel. and the solid circles are what's already been in the annual postings. Those ones that are with the outer circles with the inner green and inner blue are sales estimates for the future. And if you go into the last two billets in the legend, anybody can pull up those forecasts from Morningstar. Also, I have projected 4% in the sales and 7.5% in the earnings. So let's go to the next slide to look at that in core. So here is historical sales. Here is Allient in the black, and in the green, orange, and purple, that is the competitors, and the blue is the industry average. So you can see right now that Allient is doing very well in terms of the estimated growth over the last 5 years. They're definitely in with their competitors and also with the industry average. They're not far off from that. Next slide, please. In the historical earnings per share, same thing. You can see the black again is Allient, and the dark blue is the industry average. Now here we have Richardson Electronics and Vicor are ahead of Allient in that 5-year adjusted, but that is because they have quite a few years in there that are in the negative. If you look at starting in 2014, both of those companies have a number of years with negative earnings. Next slide, please. And here is the management, pre-tax profit on sales, return on equity, and debt to capital. Again, Allient is doing very well in those, and in years again where the competitors have gone ahead of them, again, a number of negative numbers in previous years. Also in debt to capital, Allient does have higher numbers than their competitors, but if you look down at the industry average, they're not too far off from that. Next slide, please.
2 minutes, Cheryl.
Okay, sales forecast, again, I projected 4%, and that is going to get a growth rate up to 704 million. Next slide. Here's the earnings per share. I projected 7.5%, and that's going to result in a 5-year projected earnings per share of $2.12. Next slide. Forecasted high price. I picked a high PE of 30.2 times the high earnings per share forecast of $2.12 gets me a high stock price forecast of $64.02. Next slide. The forecasted low price, I picked 16 for the low average PE forecast, which gave me a low stock price of $23.70. I picked $26.80, which was 75% of the current price, to give them a little bit of wiggle room in case the market starts going up and down. And that gives, it will end up, next slide, with a 3.2 to 1 upside downside ratio. And there you can see 35.70 is the current price with 26.8 as forecasted low price. So they are just under into the buy. Next slide. So in conclusion, Allient is a small-sized company. It drives long-term global growth, both organically and through complementary mergers and acquisitions. They're fairly priced, the current PE being 24.1, just below the 5-year average PE of 24.4. Now, if you can find Allient at $32.20, that will satisfy the 3 to 1 upside downside and a 15% return. And it could be a worthy candidate for purchase or just to put on your watch list and wait for that 3220 to come if you put it on limit order. And back to you folks.
Thank you. So I'm going to be up next, and I'm going to talk about ResMed. And the reason I picked it is we actually looked at it in one of my clubs. We actually own it, but it's also showed up, like I said at the beginning, in the top 100. It just popped into. It's new to the top 100 at 100, and I found it a very interesting company. I own it personally as well as, like I said, one of my clubs, and let's sort of go through it. Next slide. So ResMed, what they do is they focus on medical devices for respiratory disorders. So mostly people think of it for sleep apnea, but they also have products for COPD, sleep insomnia, as well as asthma. Those are their four key things, but most of it is in sleep apnea. So the first CPAP machine, which is what you use for sleep apnea, was invented and built in Australia. And again, if you download these slides, you'll be able to get the hyperlink to where it came in. So the investors took over from the person who had the original single, what do I want to say, trademark, not trademark, patent for this and the like. And so the investors took over from the doctor in 1989 after the doctor had it for about 9 years. They pretty much moved out to San Diego, became a publicly traded company in 95, and has been part of the S&P 500 for, what's that now, 7 years? And so about, as you can see, 52% of the revenue is in devices, mostly, again, the sleep apnea or the CPAP machine, but they also have accessories, and they also have that SaaS, which is subscription as a service, and that's a growing part of it. And as you can see, they have 63% of their revenues in the US, and you can see how it slowly has gotten to become more popular stock in the better investing community. Next slide. So here's some of the things. When I initially looked at this back in like September and October of last year, it was sort of really beaten down. And I was trying to figure out what's going on, because when things are beaten down, it's either a really, really good thing to buy, because as Warren Buffett says, you want to be fearful when other people are greedy and greedy when other people are fearful. I was like trying to figure out what was going on. And as you can see, if I start in the upper right, one of their principal competitors, Philips, which also has a CPAP machine, their stuff was recalled and they've been out of the US market. They're just coming back in. And so, okay, that wasn't it. You can see in the lower right, Barron's was talking about how healthcare, again, this was from several months ago, that they were also sort of beaten up as well. If you look at this overall, the biggest thing, there's been some problems where they had a whistleblower showing some things, but 39 million, while it's a lot of money for a company of this size, it's relatively a small amount. And it seems like it was something that they were able to take care of. The biggest thing is if you look at the Motley Fool story over on the far left, one of the concerns that sort of drove it down in last year was the fact that they thought that Ozempic and I think it's Wegovy, if I'm saying it right, two weight loss drugs, that those were going to be able to impact the CPAP machines, because if you lose weight, you're less likely to be able to need the CPAP machine for everything that's going on. What ResMed has been doing, they've been very clear and very strong and vociferous in terms of saying that they don't see that there's if you lose weight that you're not going to need a CPAP machine. You're still going to see it. So that's sort of kind of encouraging that overall they are still quite bullish on the overall market. Let's go to the next slide. So here's the total addressable market. I always like to sort of look around for this stuff. And this comes from, I think it's called Grand Valley Research. I've used them a couple different times, so I feel pretty comfortable with them. And you can see in the upper right-hand corner, this is sort of the sleep apnea devices just in the US, and they're expecting growth from 2023 to 2030 to grow at least 5.5%. And so, and globally, they expect the growth to be 6.2. The reason is that outside the US, there's a lot of great opportunities for growth in both Asia and also in Africa. The two developed areas are in Europe and in the Americas. So overall, you can be able to see that there's still a lot of places to grow. And like I said, the devices are only about 50% of their sales. So there's all the other accessories that you need to go with it as well. Next slide. And so here, this is another site that I like to go to, Statistica. They're a German-based research company, but I find their stuff very credible and very good. I've been using them now for a couple years. Is that you can see, like I said, there is some more growth in Europe, but again, it's really in the Asian and Pacific. And if you look at this stuff, down those graphs, they go from 2017 to 2027. And so the blues are the Americas, so that's North and South America. Then you can see the darker one above it is Europe. Then it's Asian and Pacific Islanders, and then the Middle East and Africa. And if you look at the last two, they're expecting those areas to double. And still good steady growth here. In fact, they're even looking at from 2017, that's almost a doubling just in the Americas as well. So ResMed seems to think that there's over 1 billion people that have sleep apnea, and 85% of them are undiagnosed. And they also have estimates of like 480 million people that have COPD. So there's a lot of areas, like I said, they're looking, their businesses, devices for people with sleep apnea, COPD, asthma, and sleep insomnia. So they're really, really focused on the areas that they can do, and there's a lot of great growth opportunities. Next slide. And so what I like to do is I like to look at the competitors. Now, again, we have in Better Investing Tools where you can find the competitors. But when you're in something that's really kind of specialized like this, they're going to be in a medical device kind of industry, but they may not be direct competitors. So what I tend to do is I look at a myriad of places to see who they think are some of the best competitors. So you can see up at the top, I have the online tools, and I found stuff from Manifest, from Morningstar, Value Line, CFRA. And then I also like to look at some other ones. And then I also found down towards the bottom ResMed's SEC filing, where they say they're really two competitors are Fisher Paykel and Philips. And as you can see with the color code, that Fisher Paykel is a New Zealand company and Philips is a subsidiary of a European company. And so overall, if you look at this, the CPAP machine, again, continuous positive airway pressure, is that they have the largest market share, and that Philips and Fisher Paykel have, somewhere between 25 and 32% of it. So there really isn't a good competitor in the US that we can sort of look at, but you can sort of make some judgments and some guesstimates on sort of what's going on. And that's what I do. So next slide. So with management, the founder, the investor founder, not the doctor who started everything, his son took over about 11 years ago. And as you can see, as the graph over on the left-hand side, they spent a lot of money reinvesting in R&D. And as I said at the beginning, this started with a single patent that they have. And now, if you look over on the upper right-hand side, they have over 6,000 patents globally. So they do reinvest in R&D, which is important for a medical company. They also do mergers and acquisitions. They give money back in terms of dividends. They haven't bought back any shares, but they have indicated since I put the slide together that they are going to do some share repurchases. I like the fact that Morningstar is a capital allocation of exemplary, which puts it like in the top 10%, but there's not a really great moat. So in other words, they have to be really kind of competitive with some of those other folks in there. Next slide.
5 minutes, Kevin, 5 minutes.
Thank you. So I also like to look at what's scuttlebutt. Scuttlebutt is a term that Phil Fisher, one of the early growth investors and the father of Ken Fisher, if you see him, he's an investment advisor as well. I like to be able to sort of look to see what people are saying about working at this place. And so I just sort of poke around, and not on investing circles, but what people think about working at this place. So two of the places I like to look at is Comparably, which is up in the upper left, and then Indeed over on the right. And generally I'm getting pretty positive, not spectacular, but still pretty good. And that's encouraging because, I don't know this industry and I'm trying to get a feel for it. And so these types of things sort of help me sort of figure out, and I go, okay, I can feel pretty confident looking at the SSG and some of the numbers, and we're about to do that. But overall, my market is, I see that this is a total addressable market that's growing. Management seems to be pretty good, and there doesn't seem to be any real problems. So let's go to the next slide. And so here's some things from their recent investor presentation. And as you can see, over their goal, they right now have 170 million people that they sort of have helped with their devices, and they think that they can grow that to 250 million in just a year and a half. So that's a huge amount of growth. And as you can see with the graph over on the left-hand side, you can see the breakout in terms of how much is by devices. It's now 53%. But they also have masks and others. Those are the accessories. And then the subscription as a service is 12% and growing. And then you can also see the second graph of the two, the one over on the circle over on the right, you can see it by geography. So again, it's in the US, but it's growing in a lot of the other areas. So that's encouraging for us as investors. Next slide. Here again, this shows you again the four areas that they really focus on: sleep apnea, COPD, asthma, and insomnia. And as you can see, they have, if you add up the 1 billion in sleep apnea, 480 million in COPD, 330 with asthma, and 870 with asthma, they have 2.5 billion people that could potentially be using their products. And again, they're the leader in their industry. As we were saying, Fisher Paykel and Philips are their principal competitors. So let's go to the next slide. So let's do the visual analysis. Now, a lot of people think when you're in core that you can't see what we like to see in plus, which is sort of the front side. But if you look at this, and everything that's highlighted in green tells you where I am. So I'm in core SSG under analyze growth. And the third step gives you the historic stock review. So you get to be able to see the sales, earnings, and the price bar. You don't get the pre-tax profit, but you get a pretty good idea that we have the up, straight, and parallel that looks pretty good. And that's all I got to say about this. So I'm comfortable about moving forward on this one. Next slide.
2 minutes, Kevin, 2 minutes.
Thank you. Are we on to the next slide? I'm still, my screen, there we go. So evaluate management, as you can see, I'm just going to show you the pre-tax profit. They're number one compared to their competitors. And again, these aren't really good direct competitors, but it's the best I can do with what I have. Over on the second side, they're number two in terms of return on equity. And what I've done, because these aren't really good competitors, I put in the industry average in the graph. That's the light blue one. And you can see that they've taken dips in both years, and whereas the drop has not been as strong with ResMed. And again, the biggest thing is that with the return on equity, where they're number two, the one that's ahead of them, WholeLogic, has about 3 times as much debt as ResMed does. Next slide. So I'm estimating future sales at 9, future earnings at 10. You can see I'm showing you the both historic and the ACE 2 years estimate just to sort of take a look at. And I think that's pretty reasonable when you consider how straight these lines are. Next slide. Again, with the high and low PEs, I'm estimating a future high PE of 38. That's tends to be pretty rich, but again, with high quality companies, that's not too outstanding. The historic is 43.3. I have percent. It actually should be just 43.3. And the last year was 40.7. So I'm bringing that down a little bit, and I did the same with the low. So I've got a high PE of 38 and a low one of 21.5. Next slide. Upside downside ratio, I get this actually in the hold. Current price is 198. And if we were to do this with a buy price where we get a 3-to-1 and 15% return, I need it to be at 189 and 40. So my total return is 14%. It has a payout ratio of 25%, which is fairly reasonable for a small company that pays a little bit of dividend. The yield is not spectacular, but you can see that they can clearly afford that with a payout ratio of 25%. And they don't, like I said, they don't carry a lot of debt compared to their competitors. Next slide. So my conclusion is it's a medium-sized company with steady growth, not spectacular, but not poor. Very, very good. 9 and 10% is nothing to sneeze at. It's well managed compared to its peers, and it dominates in the industry. It's probably fully priced right now, or fully valued. The PEs they're kind of closer to the higher side of the historic PEs. It's in the hold, but all it needs to do is drop by $8.60, and I get it in the buy. Pays a little bit of a small dividend, but I think, again, that reasonable payout ratio. I just need to be a little bit patient and wait for this. As Warren Buffett says, wait for the fat pitch, wait until it's completely in your buy zone and go with it. So even though it's not necessarily a buy today, I really like this company. I think it's really well positioned. And I think that it's, when you find a company like this, I always like looking at high quality companies, even if they're not in the buy zone, because then I know what the company does and I can be ready for it when the price dips. That is my report, and thank you very much. All right, so now we're going to look at two stocks in SSG Plus, and here's an error I saw. We're saying Cheryl with Allient, but that's incorrect. We're actually going to have Bhaskar, and he's going to be talking about NXP Semiconductors, and that was the stock to study, or it is the stock to study for this month. And then our newest person, Denise, will be telling us all about Comcast. So let's give it over to Bhaskar, and let's hear from him.
Good evening, all. I'm Bhaskar Aramagam. Today's I'm going to go through NXP. The ticker symbol is NXPI, sold in NASDAQ. This is NXP Semiconductors, based in Europe, Netherlands. Their primary business is in the semiconductors. They have been doing this for many, many years since the history, beginning in 1950s. So this showed up in the BI magazine April edition under the stock to study. Next. So in the BI magazine this month, April, you will see it in NXP Semiconductors NV. The ticker symbol is NXPI. It is in the semiconductor industry under the technology sector. It is a large size company because it is selling, its sales is as of 2023 is 13 billion. They are primarily leading suppliers for high performance mixed signal products. Their primary target business is in automotive market, where the majority of their market share, about more than 50%, comes through automotive industries. And they have a footprint in the Internet of Things, mobile and communication infrastructure. Next. So looking back the history, there were two big companies. One is the Motorola Semiconductor Group, which was founded in 1949 in Phoenix, Arizona. There is another company, Philips Semiconductor, which was founded in 1993. They both were with the primary business was on semiconductor. They have been doing a lot of work in many years. And Freescale is a spin-off from Motorola, and NXP spin-off from Philips, based called as Next Experience. In 2006, it was formed, and the first IPO went in 2010, and it started selling in NASDAQ. Within few years, I think it took the NASDAQ top 100. In 2015, there were the Freescale Semiconductor, which was part of the Motorola, and NXP. They merged, which is supposed to be a very big merger. And since then, it has started becoming like a large company. And there is also an attempt made by Qualcomm in 2016 to buy NXP, but it was canceled in 2018 due to the China trade issues. Next. The near field communication, or NFC, the NXP co-invented along with Sony. This is the one that is used for making payments through phones and by exchanging the data securely. And they also manufacture the chips for e-government applications like electronic passport, RFID tags, and labels. And contactless card for MyFare is used in many of the public transport systems worldwide. All these are related, and they have been having great success in these products. Next. So looking at the big picture, their primary focus is on the automotive industry. They build technologies that enable the auto sensors and which are used in the auto industry, industrial and IoT, Internet of Things, and several mobile devices and communication infrastructure. They also do like about 1% of their revenue comes from the smart home and smart city category. Next. So this has like a history of 60 years of experience, and they have been doing primarily the same tech semiconductor, and they have there are about 34,000 talented team members, and they have about over 9,500 patents, which are significantly high. And there are like 12,000 approximately R&D members. Their footprint in different countries, like 30 plus countries. And their 2023, their annual revenue was 13.2 billion. It's a large size company and based in Eindhoven, Netherlands. Next. So they have two different business units, one for the front-end manufacturing and their assembly and test sites. They are spread across the world in different places in Asia, Europe, and North America. Next. So the target market is primarily on those 4 areas. Their automotive industry brings about 56% of their revenue, which is like 7.5 billion last year. And industrial and IoT is 17.7%. Communication infrastructure is 14.9%, and mobile about 10%. Morningstar says their competitors are Infineon Technology, Microchip Technology, ST Microelectronics, and Texas Instruments. There are other semiconductor companies which our community, veteran investing community, has been reviewing in the past, like the NVIDIA, the Taiwan Semiconductors. This one is based in Europe. This is a new stock that I have at least come across in the stock to study. Next. The company has grown primarily by merger and acquisition, and there are a lot of companies, but that has been acquired by this for various reasons. That in 2022 they acquired the PLSense for 22.1 million for low power components for IoT devices. They purchased Retune DSP for 15 million, which is a device voice control software. There was a spin-off after the merger, which was called, I think, Amphion, which was a spin-off from this one. Marvel, which is a big acquisition, which is 1.8 billion for a Wi-Fi connectivity business. In 2018, they also acquired Omify. This is to improve the automotive Ethernet solutions. The 2015, the Freescale Semiconductor is one of the biggest acquisition. This merged with the NXP, which took, I think that is when it started becoming a very large size company. Next.
5 minutes,
Slide.
guys. 5 minutes.
Thanks. Next slide. So what do the analysts think? Pulling from Morningstar. Morningstar's fair value assessment is 240. As of March 31st, it was selling for 247. Value line, as you can see, it is almost on the value line, the black dot, which tells it is like fairly valued. The most recent trailing PE was 18.7 at the time, which has changed as of yesterday. The one below with the blue is from Manifest Investing, and they rate the quality as 81 with a PAR of 7.8%. CFRA has been recommending a strong buy until November, and the price was very low at the time. It was 183. I think in January or February they changed it to a buy. CFRA has very good opinion about this company, and they are thinking it has potential to even grow, and it is a good time to buy. Next. So going into the SSG Plus, as you can see, the sales is almost flattened, which tells it is like a matured company. In 2016 and 2020, the drops are primarily due to the mergers. 2015 is when they merged with Freescale. 2019, they purchased this big company for 12 billion. So other than that, it is almost like straight and parallel, little bit up. The red mark on the last price chart, which shows it is almost at its 52-week high. It is selling at a high price for now. Next slide. So looking at the analysis of the growth and the quality, fundamental company data, the company has been growing for the at 8.6 on an average for the past 10 years. Of course, there are a lot of numbers that are going up and down, mainly because of the mergers it has been happening. Based on the numbers, I'm forecasting a sales growth of 7% and earnings per share about 8%. And the pre-tax profit is 14%, 5-year average, and ROE is 20. Anything above 15 is good. The debt to capital is high. I think it's mainly because of all the new acquisition they have been making, but it has started to come down, although the numbers are high. The bottom annual rates are coming from value line. Value line revenue projection is 10% and earnings is 10%, and the earnings per share of $20. My sales estimate is coming to 18 billion for the 7% growth. Next slide.
2 minutes, Bhaskar, 2 minutes.
The PE history, it is almost the current PE and the 5-year average PE is in the 20s. The current PE is slightly over the 5-year average. There are two anomalies in 2019 and 20, which I removed. It is keeping it in 20. Next slide. So overall, based on my estimates, the high PE estimate, I have a 26.6 and a low PE of 16.6. That brings the current price is 247, which falls under the whole zone. Anything below 235 would fall in the buy. Value line projection says it could go up to 430 and a low of 290. Next slide. Of the 5-year potential, it is based on my estimate of high PE, it comes to 19.2%, and the projected return of average PE is 16.5 with an upside downside of 2.4:1. Next. In conclusion, NXPI is a large, quality, well-established but slow-growing company. It has been growing with a lot of acquisitions. Currently, it is fair valued and trading close to its 52-week high. The semiconductor business is an attractive business industry at this moment because of all these modern technologies which depend on them. It is a dividend-paying company with very good payout ratio. My SSG turns out to be a hold with upside downside of 2.4:1, with a buy price below 237. The current price is 247.7. I would put it on the watch list and watch. If it goes below the buy range, I would consider to buy because of the industry. Thank you.
Thank you very much. And so we have our last, but certainly not least presenter, Denise Kimberlin. She's a former president of the DC regional chapter. She's going to be our 31st different presenter since we started this about 2.5 years ago. And Denise, you were going to talk about your club. And so, Kent, do you know how to do this while you stay in the screen here? If you hit 1-6 and enter, we'll go back to the slide where Denise can talk about her club, the Palmetto Moneymakers. Basically going
Palmetto, yeah.
There you go.
Palmetto Moneymakers is a South Carolina chapter model investment club. We meet on Saturday mornings, the first Saturday of the month, and we meet at 10:30. Usually we're done by 12 to 12:30 on Saturdays. We're told that this is a good club because it's a very educational club. So we appreciate that. We are meeting next Saturday. Well, not yesterday, obviously, but this coming Saturday. And as I said, it will be at 10:30. We do ask you to register. You can just register online going to our webpage at Better Investing. I think that's everything. So if you go back.
Yeah, so it just hit 8-2 and we'll go back to where we're supposed to be.
There we go. Okay. I'm talking about Comcast, and I want to let you know that I did do this in SSG Plus on the website. I put on here just some of the big names that I thought people might recognize that Comcast currently has either a majority stake or they are a subsidiary. And the Verizon, before anyone asks me, the Verizon is wireless. So it's Verizon Wireless, and they bought that back in 2016. So they've had it for a while, but it shows you the diversification that Comcast has. Next slide. I'm going to talk about who they are now, but also where they are expected to go, where they expect to go. And then we're going to talk a little bit about why you might want to invest in them. And again, talking about is now a good time to invest. Next slide. This gives you an idea of who they are now. They have a lot of different names that you might recognize. The Xfinity brand is their, I guess I'm going to say Wi-Fi, internet, and also their cable. And just so that no one needs to mention it, cable is kind of going the way of the dinosaur. So a lot of people are getting away from their cable, but going to streaming. We'll talk about that in a minute. Next slide. These are also some more. These are their content and experience platforms. And again, you see they have a lot of different companies, some of which you may recognize, some of which you may not. Just to let you know, Sky Sports is actually a European company, mostly English-speaking countries. But anyway, they are expanding into that international market. Next. So the big thing is, where are they going? And the first thing, as I said, to know about them is that although many of us know or know of Comcast as a cable company, cable provider, but they are actually, that business is shrinking, but as it is shrinking, they're getting into much higher margin businesses. And these include things like their theme parks, which are the Universal, NBC Universal theme parks, some streaming platforms. They are also working to market improved broadband for a lot of businesses, business connectivity, international markets, and as I said, that especially with the Sky, the Telemundo, those are specifically going into international markets. They also have a big presence in advertising. Next slide. So they identify their key growth drivers as I said, residential broadband, the wireless, business services, theme parks, streaming, and this includes Peacock. That's their big one right now because it's recently started and it's just getting to the point where it is actually making positive earnings per share. And then, of course, they also have a lot of film and television studios. So a lot of places make movies, make television shows at Comcast studios. Other important businesses that they're expanding is their connectivity and platforms for video and voice, media networks, advertising, and then other businesses as they can get into them. Next slide. Their key objectives, and this is from their end of year earnings call, but their key objectives is to remain disciplined on broadband, navigate the TV evolution for profitability, and we all know that television is changing fairly rapidly right now. They're also focused on driving operational efficiencies. That's really important with all businesses right now. So they're moving along. Next slide. So why would anyone want to invest in a business like Comcast that is known as a more, I guess I'm going to say, a more dying business? We're all, or many people, are moving away from cable. Comcast, although it is the leading US cable company, a cable provider in the US, but that market is steadily shrinking. But as I said, they're moving into higher margin businesses with some acquisitions that they've made. The very first one was back in 2009. They acquired NBC Universal. And then in 2016, they acquired DreamWorks and Verizon Wireless. And in 2018, they bought a majority of Sky Communications. And I think that was all Sky Sports, but that is mainly in Europe, and it is mainly soccer. So, which is big there. Of course, they call it football, but it's very, very popular there. In addition, they have agreed to sell Hulu in 2023, and they're negotiating a price. They have a price that they started with, but they think, or many think, that it is actually worth more, and so they expect that amount to go up, and it should bring in a great deal of cash. So, as I said, they're creating some long-term shareholder value with these higher margin areas. They're projecting growth on into the future, and they have current and expected future investment grade credit ratings. And credit ratings in today's marketplace is very important because that's the level that they can borrow at. Next, please.
4 minutes, Denise, 4 minutes.
Thanks. Okay. In 2023, they returned $16 billion to shareholders mostly in the form of dividends and payouts. So that's something to keep in mind. Next. The SSG, and as I said, this was on plus. You'll see that their revenues have been growing fairly steadily, but their earnings per share and their pre-tax profit are both rather bumpy. Part of that is just the economy. 2020 was a bad year. 2022 with the inflation was a bad year. So some of the bumpiness, if you will, is due to that, and due to the acquisitions and kind of smoothing those out. When I forecasted this, I forecasted a very low growth rate for sales. Looking at what analysts were saying, this is actually about in line, and it's pretty much what the last quarter over quarter, has been. In addition, I looked at earnings per share, and I forecasted 10% for earnings per share, and that was lower than the current earnings per share forecast growth of about 11%. And when I looked at over the past year, it was a little bit lower than what it's been, but not much. I think it has been just under 11% for the past year, and so that's kind of where I sat that. All the management evaluation are up, or what we would like to see, I guess I would say. Pre-tax profit, return on equity are both up, and then of course debt to capital is even. They pretty much manage their capital, their debt rather, pretty sanely, I would say. Next.
1 minute, Denise, 1 minute.
Okay, thanks. Next. Okay, when we look at historical sales, and these are the competitors, Comcast the biggest fish in the pond is that black line at the top, but you can see it's been fairly steady, where the competitors for Comcast have not necessarily been as steady. There's been a lot more bumps. Next. Historical EPS, earnings per share, has been also very bumpy. Comcast has been fairly stable with that. There have been a couple of dips, but overall. But the others have been a lot more unpredictable. Next. When we look at historical, or I shouldn't say historical, I guess I want to say the peers, but over the last 10 years, Comcast is still very high. It is the strongest both in pre-tax profit on sales, on return on equity, and as I said, they're pretty stable on their debt to capital. Next. When I projected this for a high price, I used the 5-year average PE of 19. And as I said, the earnings per share, we used a growth rate of about 10. The current PE is 11.7, so the 19 is higher than the 11.7. Gives us a chance. Next. When I looked at the low stock price, I figured the current is actually lower than the average, or the low average low PE, but I said, you know, PEs can always go down from here, especially with the current economic situation. So I chose a low PE of 10, which changed things, and then the earnings per share forecast, of course. So that gave me 37.1, but just to be comfortable, because I feel like this is a little more cyclical type company. So I actually used a forecast low price of 34. I just feel like with cyclicals, they're a lot harder to anticipate. Next. That, however, does put it quite solidly in the buy zone if you don't mind the fact that one of their known industries is definitely a declining industry, but they are definitely working to expand into other industries. That the current buy price gives them an upside downside to 7.5 to 1, which is maybe a little more, but they say that the reason that the price is a little depressed right now is because of the fact that so many people out there assume that this is a cable company and cable subscriptions are declining. Next. So in conclusion, this Comcast is a very large company in the communication services sector, telecom services industry. And so if that's an industry or a sector that your portfolio needs, this may be a company that you would want to look at. It's a scaled leader with top brands in very large profitable markets, and it has a very strong balance sheet. They are investing in and driving growth in high margin businesses, and they're protecting their profitability in other businesses as much as they can. It's currently undervalued, and it's currently trading below its 5-year average PE, certainly. So at this price, at this point, this may be a worthy candidate for purchase. As always, we recommend that you do your own research. This is not a slam dunk. I'm going to tell you that right now. It is a company that is a little bit less predictable than maybe we would all like, but it certainly has good potential, especially with moving into the high margin areas, businesses that they're aiming for. So that's my conclusion. Thank you.
Thank you, Denise. So we went through these fairly quickly, but we just sort of like to do sort of a recap from all of the presenters on NXP Semiconductor, Comcast, ResMed, and Allient. And we like to have all of the presenters sort of go, if we go to the next slide, and what we do is we look at the life cycle. This comes from T. Rowe Price, and it shows up quite prominently in our handbook. And it's just like all companies sort of have like a life cycle, like a human: growth, maturity, and decadence. And why don't we start with you, Cheryl, and say, why did you pick this location for Allient in the red there?
Well, Allient is a small company, and as you can see by all of their acquisitions, they are pretty explosive. And the fact also that they're going into, as I said, things that are trendy, if you will, with AI and in the different markets that they're in. So that's why I believe they are still in explosive growth.
Okay, I'll go next. I have ResMed, and like I said in my concluding slide, I look at this as a steady grower. I mean, I have it 9 and 10% for sales and earnings, which is really good for a medium-sized company. It's not spectacular, but it's not slow. And I think this is where it is. The market's growing pretty well for it. I think there's a lot of opportunity for it right now. And that's the reason I have it right there, a little bit more on the explosive side of the midpoint, but clearly not mature yet. Bhaskar, you want to tell us why you picked that location for NXPI?
You need to unmute, Bhaskar.
Maybe he's not there. So, Denise, why don't we come back to you? I didn't really have a clear idea where it was, but I think it was somewhere in this mature growth was where you were thinking of it. But go ahead and tell us why, if you want to move it from that location.
I think that's actually a pretty good one. I think that Comcast, because Comcast is so very large, it's over 100 billion in revenues. I would say it probably is in the mature growth, and we're not expecting a lot of revenue growth, but I think that the earnings per share growth that we're projecting is because they're moving into maybe some different company or different businesses that are higher margin. I guess I'm going to say I'm still just a little bit concerned about Comcast, because while that may be their intention, that doesn't mean that it's going to be totally successful. But I think calling this mature growth is right on target. I might move them a little closer to Bhaskar's, but somewhere right in there.
Okay, and let's go back. Let's see, Bhaskar, are you with us? And if so, make sure to unmute yourself and tell us why you picked that location for NXPI.
Yes, I am here. NXPI has been is a large company, and it has been growing primarily on acquisitions. I think it is at the place where it has maxed its growth. From now on, it all depends on the industry, how it is the technology industry is going to evolve. Based on that, there will be more room. For now, I think that is the right place.
Okay, thank you very much. All right, so we've done doing all the talking. Let's go to the next slide, Kent. And it's now time for all of you to be able to sit there and tell us what you think of this. You get a chance to vote. And again, we're not necessarily saying vote for the one that's the buy, because again, we have several of them that are not. But which one intrigues you enough that you want to do further research? So Cheryl, can you do it? There, or someone? There we go. So the poll is open. It's free to vote. You've been listening to us, Yak. Here's your chance to be able to decide which one you like the best. I see we have just about 40. Now we're up to about 50% of the people voting. Let's see if we can get up a little bit on the higher side. It looks like it's a really close race between a couple of them here. So here we are. We're just short of, so now we're at 60%. Let's see if we can get up a little bit higher. I feel like I'm channeling my inner Ken Kavula and sort of being a auctioneer and trying to get people to go up higher and higher. We're at 68% of you voting. Can we get up into the 70, maybe even 75? Any more? It's staying pretty steady right there. Let's see if we can get one or two more votes. I don't think people are voting. I think they're done. So go ahead and share that. And there it is. Maybe I tweaked everything by saying, since mine wasn't a buy, to go with ResMed, because it clearly is not a buy in my estimation, but it still looks really, really good. So anyway, but I thought we had four really interesting companies to take a look at. We do have a couple questions in here. One was Brian was asking with my presentation, he said that he have if we can go back to, can you do this, Kent? Can you go back to, can we take this back and let's go to slide 62. I know, again, I put a lot of information in there, so I was trying to condense the number of slides. But if you look at this over on the right-hand side, I've estimated that the low price would be 130. It's currently at 198. So that's a drop of $67, almost $68. So that's about 34% off the current price. I think that's maybe have been a little hard to read because things were really kind of small. Maybe I should have done these on individual slides to help out. But anyway, that's sort of where it was. Brian, if you have any additional questions, go ahead and raise your hand, or you can just type more in there. Let's see, do we have any other questions from the audience? We've had quite a few church mouses the last several months here. No one wants to be able to jump in. Any hand raising? Do we see any hand raising in our audience? Nope, I don't see any. Wow. We're going to have to maybe give people prizes for asking questions and raising their hands. This is we haven't had that's the most questions we've had. Thank you, Brian, in probably our last 5 months combined. So yeah, it's sort of dropped away. So we can go back to, I think we're on probably 110 or so was our slide, somewhere around there. Maybe go back. It's probably let's go back. Maybe it was what would it have been?
Nope. Right there.
So yeah, so here's, again, if you want to be able to reach us both at Digging Into the BI or at the Maryland chapter or the DC chapter, there's where you can find us. And there's several of us at the last Bink, which was in Dallas 2 years ago. Come join us in May when we're going to be in Chicago. Many of us will be there as well. And we're glad to have you and to be able to connect with you. Again, I see we have several people from outside of the Maryland, DC, and Virginia, and we're glad to have you. Let's go to our next slide. And if you do want to be able to join stuff, again, you don't have to be in the DC chapter. You can see up at the top how to get to the DC chapter in the Our Community part. But again, sign up for that and we'll get you'll join our email list. We're not going to inundate you with a lot. It's usually either stuff for the book club or the digging into BI or some other educational things we have going on. Next slide. Kent, this is all you.
So you all might ask how we get paid. Well, we get paid as volunteers, and we end up with some good investing knowledge. We help educate other folks, and that actually helps us build our investing skill set quite rapidly. Part of the benefits of being a volunteer is you get some complimentary subscriptions to the Mutual Fund Education Center, as well as the Better Investing website tool set and the online data feed. And so those are things that help out when we want to provide more knowledge to other people, but it also helps us out. And next.
And so here's what we have coming up for next month. The stock to study is going to be Motorola Solutions. And then the undervalued feature is Darling Ingredients. We also think, we're not 100% certain, but we I think we hornswoggled a new person in to do Addis Home Care. And do we know what our fourth one is? You were talking with our other presenter, Linda. Cheryl, do we know what she has yet? Or is it to be determined?
I gave her several ideas, places to look. And so she is going to get back to me as soon as possible.
Very, very good. Okay, let's go to our next slide. And what we do is we have these all up on Manifest Investing. That's a separate subscription. There's no direct connection between Manifest and Better Investing, but many of us do use it. And I have all these different dashboards. I think I said 9, but now it's even more. I do it by every year to just sort of take a look at it. And this is free. You do not have to have a subscription to Manifest, and you can sort of see how we've tracked everything for each year. So let's go to the next slide. And there are all of the dashboards that are there. And again, if you downloaded these handouts, you can then take this and you can just click on it and it will take you to that location. So you won't have to go hunting and looking for it. So go ahead and do that. So you can be able to see how well they performed, which ones were the winners, which ones were the general selections and the like. And yeah, that's really it. We have one more slide, I think. And so again, up at the top, that's again our link to the YouTube channel. It should be up later on today or maybe even tomorrow morning. And this recording will be there. And again, please share this with people in your club, in your community, people that you think would be interested in this type of stuff, just to sort of see how we put together presentations. I see some of our previous students in our classes, Cheryl, are in the audience, and we're glad to have you.
Great.
And please stay connected with all of us. This is how we all learn, is by doing it together. And so thank you very much. And if any of you have any kind of gumption and want to actually do a presentation, we will work with you to help get it better. I see there's several in the audience, several people that have done previous presentations. And again, thank you for that. And thank you, Denise, for joining us, and Bhaskar for being a regular participant. And Kent and Cheryl, thank you very much. So anyway, this is how we do things together in our community, and we'd love to have you. And again, come join us on May 6th, the first Monday in May, when we'll be looking at the next issue of Digging into the BI. And thank you for being here. Good night, all.
And please copy out the handouts. We'll try to leave it up another minute or so. And these will give you the places to go to either YouTube or Facebook or whatever to look at the highlights. Denise, thank you very much for participating tonight with your busy schedule.
You
well,
know,
thank you for inviting me.
Denise, the reason why Cheryl and I did this is because you roped us into a 4-bit, so we had to return the favor.
I know. I know.
That's how this works, right?
Yeah, but now I've paid my debt. I just want that
Well,
out there.
if you have us do this presentation again, like say maybe at Bink, we may have to come back with another one.
Maybe we'll have to rethink that, huh?
Yeah. Don't worry. We'll have we won't turn around and have you do it right away. We'll give you 2 months off. How's that?
Oh, well, that's good. At
Maybe
least 2
more
months.
like 6 to 9 months. We won't swing around real quick. So, but yeah, if there's please stay in touch and we'll be able to find another one that maybe you're working on that we can share, or one that intrigues you. So I think we can let it go.
Good.
Looks like everyone else is sort of sitting there, and if they haven't gotten it by now, they haven't. So good night, all, and we will see you next month.
Good night.
Good night.